back to the Capital Mindset Show. We are your hosts, Austin and Fabio, and today we have an episode going over Activision stock, ticker symbol ATVI, which we actually, case in point, are very excited about this stock for a multitude of different reasons. We're going to be kind of summarizing today what's kind of going on with this stock, as well as sort of our future prospects for what we believe the stock could go to, as well as also the way that the business could, in essence, perform over time. So without further ado, what are we looking at here today?
All right, so this is the analysis. Right.
This is the analysis.
It's going to be such a S tier analysis that you've never seen on YouTube before. Everyone ready?
Yes.
All right. So
those of you who don't know,
nope, Austin. Stock goes down, then stock go up. Now stock go down. Therefore,
stock go up.
Yeah. And then stock go up.
Okay. All right. Cool.
There. End of video. You can click off.
It's done.
All right. If you're still here, we'll do it. This is the beginning of the actual analysis. So we have this kind of pulled up to kind of give you an idea of what's kind of been going on, why we're interested. And it's basically this recent price drop and the reasons behind this price drop. So Austin and I will begin the video by discussing this and going over what we think about it. So Austin, give us the spiel as to what's kind of going on. Why did it drop? And if you don't know, then ask me and I'll give you my opinion.
Okay. So as far as I'm aware, there's two main reasons and then one third reason that I don't even really consider a third reason, if I'm being completely honest. The first reason is that two of their biggest titles, Diablo 4, I think it is, and then Overwatch 2, both got delayed out until 2022 or 2023.
Are you a gamer before we begin?
Yeah.
Are you do you play those games?
I do. I play a lot of Diablo. Diablo is a fun game.
Never played
that,
but
it's a lot of fun. It's a great game. But yeah, so anyways, basically the case in point is that two of their big titles are releasing into the future. So that also impacted the stock. Okay. There's an ongoing lawsuit too, as well, about allegations of sexual harassment and workplace discrimination and stuff like that. It's caused one of their executives to resign, stuff like that. And then interesting enough, the SEC also got involved with this as well. The SEC is now actually investigating Activision itself. And it's funny because I'm reading a lot online. People are making it sound like the SEC is investigating the actual cases of this lawsuit itself. However, what the SEC is investigating is actually, did Activision fail to disclose these potential risks that they're now being sued for to investors, if that makes sense? And then the third reason is that they have like poor earnings guidance.
Pause there. So you're telling me journalist majors are writing about stuff and stretching things?
And I wouldn't say they're stretching things. I would say that like they're basically getting the central idea, just they're not understanding the way the SEC works in these instances. So do you think the SEC has the power to investigate a business about workplace discrimination? Or do you think the SEC has the power to investigate a business about the potential of them not disclosing the risk that they could get sued for workplace discrimination in their financial statements? That's the difference here. So that the journalist majors are not exactly wrong. They're just kind of missing what the SEC does. And then they're phrasing it as if the SEC is investigating for workplace discrimination and all of these other sorts of things. And so because of that, we've actually seen a pretty significant drop in the stock price. So what are some of your opinions on that coming into this?
Well, yeah, I think for Activision Blizzard, I think the company was priced for almost perfection. You know, we can use that word. They were priced a little bit for perfection. Definitely not based on the true fundamental growth metrics. Because when I did an analysis on Activision Blizzard earlier this year, the prospects were not very favorable. And I don't know if we discussed about it earlier this year, but I knew I discussed with either one of my colleagues or something, and it came up because we wanted exposure to the video game industry. We ended up choosing another company, but now we are looking back at Activision. You probably know what the other company is because I've been always telling you, I like this one better. But I did like Activision Blizzard because some of their titles, like the one I'm the most familiar with is Call of Duty. I haven't bought a copy of Call of Duty in a long time. Just because
it's still wildly popular.
It's so just because I don't play it doesn't mean a lot of people other people
Exactly.
don't play it. Like
Overwatch is another huge
never
game
played it,
Activision has.
but I know it's
fun.
popular.
It's a pretty fun game. Yeah.
So case in point, I was aware, obviously, I'm of Activision. I don't live under a rock, and I know that Activision has a lot of titles that a lot of people enjoy. So that being said, I just was waiting for an opportunity to enter Activision. I actually, you might not know this, I did own Activision in the past, and I bought it when this was happening, and I sold it in 2019 to get capital to sorry, not 2019. I sold it into 2020 to get capital to put it into another position, and that was a mistake because I missed out on, like, a decent amount of growth. But who cares? That's not the
Hindsight's
point.
always 2020.
Exactly.
Yeah.
That's not the point. Now I'm looking at the prospects today and what I'm being offered versus like what I think the business will do. And I personally like it, and I don't think the reasons for the sell-off, those all being coming together. I think that the business was just priced a little rich, and it just needed something to just take it off. And these are just kind of like excuses. And I do think a lot of the investor base, well, actually, not necessarily the case, because this is a large company, so it's not like the entire investor base is like a retail investors. I think this is kind of like a sell-off just because maybe algorithmic selling, but that would be something we look into separately. But I don't think, my point is, I don't think that the sell-off is justified to this extreme. But yeah, that's my opinion. You in the comment section, you may disagree, and you can leave your thoughts down below and say, okay, well, you're wrong because this, and this, and then I'll take a look at it, because I actually I would love to be proven wrong, or I'd like to hear the other argument.
Well, I mean, Fabio, after all, we do love the sound of our own voices. So but kind of revisiting the entire thing with the SEC again, I might be wrong in saying the SEC may not have jurisdiction to investigate specifically cases of workplace discrimination. If I'm wrong, please feel free to correct me in the comments. However, I kind of want to explore and sort of give my thoughts on what some of the ramifications of this might be if the SEC does determine that Activision did not properly disclose this risk to investors. And first and foremost, I don't actually think it would cause Activision to go bankrupt. However, the future consequences of what would happen, whether or not it's a fine, et cetera, so forth, the future consequences of what happened could have a potential effect on the business. And the business itself is incredibly strong. Its cash position is like actually pretty incredible. Their assets on their sheet are also incredible as well. The business financials, the fundamentals themselves are incredibly strong. They have, as I was looking at it last night, they have a like revolving credit facility, which is basically they have access to debt and they're not using it, primarily because they're having a lot of this cash come in from operating activities, which, as I've said in other videos, and for those of you who might not know, I disclose this every video, I'm a new investor. I'm an accountant coming over to the investor side. I just started investing again in July. I dabbled a little bit in 2018, but wasn't really passionate about it. And then 2020, I kind of came back, and that's when I was like, all right, this is something I really want to become passionate about. So case in point,
I dragged him down the rabbit hole.
Yes. The case in point being here is that there's just some things that I look at just drawing from my own professional experience, especially kind of looking inward into these specific companies themselves. So back to what I was talking about here is that I like businesses that typically fund themselves with cash from operating activities, because then they're not diluting shareholders and they're not drawing debt. Now, I know that's kind of, there's definitely like specific nuances to that concept in and of itself, but just sort of the macro overview of that concept, that's typically what I like to look at when I like to invest.
So in regards to Activision, you like it because they have a tremendous amount of cash relative to their liabilities. We'll see that in the model itself. I kind of want to share with the audience, just in case they didn't know, because not everyone's a hardcore gamer. So these are some of their franchises that you may be familiar with. So we know World of Warcraft, South Park memes there, and
Candy Crush.
Yeah, no, that's because they think they own King Digital, which is their mobile division, and mobile gaming is growing very quickly. So they also have Hearthstone, Overwatch, and of course Call of Duty. There's your Diablo right there. So Yeah, right here, King Digital, Activision Blizzard Esports. I see a lot of people are bullish about that. I don't even really care too much about that per se.
Esports?
Yeah, I kind of just see it as a call option for me in terms of like from what the business
Just
offers.
thinking,
I like
yeah.
the Activision part, like so the publishing of different titles, and I like the
Yeah.
Blizzard Entertainment and King Digital. Like I'm buying it for the video game aspect. The other stuff, if they succeed, that's awesome. That's great. Consumer products I do like because obviously like you have people who are fans of their content. They'll buy like, shirts and stuff, to showcase that they're fans of these entertainment software devices, not software products, because that's basically what they are. And the reason why I'm saying it that way is when we look at the margins, we're going to see these high margins showcased in the business because it's software based. So without further ado, actually, I think we should just like go into the model and kind of just start explaining some stuff. But
yeah,
before we
something
get in
else
there,
that's also important to kind of note too is just sort of just kind of taking a quick overview at like Activision's moat. A lot of these brands that they currently have and are producing and make games for this provides a pretty incredible sizable moat for Activision itself. So that in and of itself is another reason why I was really excited when I actually called you and we had a conversation and I was like, I actually think Activision might be in my personal buy range. And you were like, no way. So now here we are making this. So
oh yeah, because I wasn't even looking at Activision, so I had no idea that they were selling off. I was busy with life.
Yeah.
So that's why it's good to have
sometimes
a community.
It's like that.
No, so that's why it's
yeah.
good to have a community where you can go to and you have all these other eyes looking around and they can point something out. So let's kind of go with Activision. Let's do it, the standard market rate of return. I say this a lot, but I have a little bit of a gripe with that. And let's assume no buybacks. They've probably been diluting. So let's go ahead and do a dilution percentage of 1%. Let's be a little more aggressive. And now let's do some assumptions on the growth rate. I think everyone's kind of known about the range of the gaming market and what it's kind of growing. So let's say between 10 and 20% for now. So 10 being a low point. Let's skip over to 12. Let's actually say 13%.
15 and then 20.
Yep, 15.
That's
okay. So it was a kind of spoiler when you did 10% and it came out of buy, everything above it would also be buy. So this is the standard market rate of return. If you were looking for that, there you go. You can have it. I don't like to stay in this realm for too long because I don't really care.
Safety.
Yep. Yes.
Like
so we're assuming, let's assume the dilution will be a little more conservative. So now we can kind of see what we're getting at. So in order to get that 12% required rate of return, we would have to assume let's actually change this up to a 14. So we could assume a 14% growth rate in the cash flows, and then we can assume a dilution of 1% per year, and we would still come out okay. Let's actually assume, I know they have a buyback going on, right, Austin?
Yeah, but they haven't actually like they've authorized a buyback, but they are paying a dividend too, I'm pretty sure as well.
Yeah. So let's assume a buyback of 1%. Now the story kind of reverts in on itself, and we can assume, let's see, 11%. So now you can assume 11% or more. So now for those of you who have been waiting for a little bit greater margin of safety, we can now play around with these numbers. And now you can see that probably, let's see, 16. So 16 to 20 is where you kind of have to, or sorry, 16 and above, because obviously if it does like 50%, you're good to go. But assuming the buybacks of 1% and the a growth rate in the cash flows of 16% or more, this looks like a promising opportunity. So now let's go back and do some dilution, see if the story does change. Okay, so the story does change a little bit. We can't assume 16%. I think we can probably assume 18. Nope. What about 19? All right, so 19%, a little bit above 18, just under 19% is what we'd have to assume and above. I want to see now with the even greater margin of safety, what are some of the numbers we'd have to assume? And let's take away the buybacks for now. So no dilution. And we can kind of see here that we'd have to do 20% probably or above. Yeah, so 20 and then
about 25.
Let's go a little crazy. And then Probably let's do 22. And last one, probably like
23.
27.
Alright.
Like just under. Oh, you want a 23? I can do 23.
Yeah.
All right, let's actually remove this one and just say this is 23. There you go. So we're actually very close to that. And now let's assume the dilution to be somewhat more conservative. So we can kind of see here. Let's actually plug in the 27 here. So I have to get close to 30%. So about 27, 26%, because if I change this to 26%, I'll slow down here because everyone's probably just trying to watch the numbers and listen. So let's comment about these numbers.
Yeah.
We're trying to just kind of figure out our estimations. But basically from what I can see here is if I assume dilution of 1% per year, and I want to make about 20% per year based on the fundamental cash flows, and I assume I make these five assumptions on the growth rates of these cash flows, I can see that I need to expect about 27% growth rate in those cash flows or more. Okay. And that's again, if you have a margin of safety there, because the margin of safety, for example, if you're doing market rate of return, we're about doubling that. So we have about an extra margin of safety, about 100% there.
Yeah.
But if you want to build in that margin of safety, which is how I like to invest, I like to build in that margin of safety so that if some of my assumptions are incorrect, I still come out on top. So let's actually assume that they start to buy back shares over time, see how the story inverts. And then if they do even more than that, but I'm going to keep it at 1%. But if they do more than that, then you can expect something there. Or if you want to reinvest those dividends that you receive, your percentage ownership of the business will grow over time. So the percentage of these cash flows that goes to you will grow over time. Effectively, they do the same thing as buybacks when you reinvest. Extracting out the tax implications for those of you who may be thinking that, yes, because buybacks in a sense for now are tax efficient. Remember, there is some changes that may or may not be coming that will tax buybacks. As the filming of this video, we do not know if it's passed or not. But so when you're watching this, it may be passed or it may have been rejected. But the point is, effectively, it will do more or less the same thing. It will reduce the share count or in effect, increase your ownership percentage of the business. So I'm liking what I see here because I actually do think they're capable of hitting these numbers as the rest of the world kind of embraces more gaming as they produce more and more titles. I think Activision is the leader in this industry, barring Sony Game Studios and Microsoft, because we know Microsoft's making some acquisitions. They acquired Bethesda, which now, Elder Scrolls is a very big game. And now that's going to be exclusive to the Xbox platforms or the Windows platforms. And we know that, for example, Sony has their own exclusive titles that they produce in-house. So this is kind of a platform agnostic game company. You buy whatever console and you can play their games. So I kind of like that. And I think they are the leader in that category.
Yeah. Let's kind of also explore too a little bit
the ratios, right?
Not only that, but also what could Activision do to actually achieve a 27% growth in cash flows over the next 10 years? In my opinion, I think it's completely possible as long as they keep their strategy oriented around making sure that they are very cash heavy. And then also the way that they get that cash is basically acquiring or maintaining very, very good quality IPs. So for instance, they keep putting out fantastic Call of Duty titles every single year. That will really, really help grow them. And then also too, if they also acquire new IPs and those IPs sort of ascend to the level that Call of Duty and Overwatch, et cetera, Diablo, World of Warcraft, et cetera, so forth have ascended to. If those new IPs ascend to that same level as well, I think it's more than reasonably possible that they could probably achieve 27% or higher growth in cash flows over the next 10 years.
Well, let me interject there because you're saying you're basically listed out existing IP. So what can we mainly expect from that is continuation. So maintenance of the cash flows. A new IP will bring in new cash flows because if they keep releasing a Call of Duty title every year, that basically almost, you can think of it in a way as recurring revenue under the assumption that more or less around the same amount of people will buy. Now the growth opportunity there is basically more consumers buy the product. So I think Modern Warfare revitalized the Call of Duty franchise, right?
Yeah.
And so a lot of players had left and had stopped buying it because they thought it became too cartoony, too chaotic. And then Modern Warfare came in.
Same thing every year. Yeah,
exactly.
Stuff like that.
Modern Warfare came in and revitalized the franchise and brought in a lot of new players, and they witnessed that growth. That was a good move on their part. So if you could do that across the different franchises, that's how you can have growth. Otherwise, it's kind of like maintenance. Like World of Warcraft, their business model, it's a cash cow at this point, and it helps fund other projects. So EA has FIFA, and I would always tell my friends who bought EA's games in terms of their sports franchises, that they were being duped because the game was essentially the same every time, just little cosmetic changes here and there, some
tiny little gameplay changes, stuff like that.
It's a cash cow. So like, I love those games. So the companies that have those is Take-Two Interactive, because they have 2K, those of you who like basketball, and EA has FIFA. So I think a little bit of a spiel there. Those are beautiful because you're getting these consumers who are just buying the same game essentially every single year without fail. Literally. And then a lot of them may be buying these packs to get maybe other players, etc. There's different ways. And then EA has Madden as well. And I think Take-Two has the WWE game. So these sports games are just cash cows. Activision, from my understanding, doesn't have the same, but like Call of Duty is their version. But you see, like with Call of Duty, they got to develop a story. A lot of times they got to develop maybe new mechanics. See, with FIFA, Madden, all this, the same mechanics, same players.
Boom.
There's no story mode
pumping them out
per se, like with all these voice actors, etc. It's a little different. It's not like it's not the same. It's not the same level of work that would need to go into them. And I think there's been a lot of complaints recently, but people have been discovering this like in the past couple of years, or not discovering, highlighting it more these past couple of years, but it's, been going on for a long time. But anyway, well, my point is that they need to expand into new franchises, and we need to see that. I think the mobile gaming industry is huge because there's been a lot of studies showing that so for example, females are the largest growing portion of the mobile gaming sector. And that's a huge growth opportunity because percentage wise, the majority of console gamers, PC gamers are male. So that's a huge untapped market to get those females to start playing these games, and then, generate income from those players as well. So, and I think, our phones are going to get better and better and better. The quality of games are going to get better and better and better. The games that the kids in 20 years from now are going to be playing are going to be incredible. I think that Activision can sustain itself through this time period and, be one of those players 20 years out, still providing games. But that's just my personal opinion.
So the biggest thing that we need to kind of keep in mind here at Capital Mindset in regards to Activision is that if you spend any amount of time online, a lot of people don't like Activision. If we're being completely honest, it's a lot of gamers that don't like Activision. There's a lot of negative consumer goodwill amongst gamers and Activision. So that's just something
among all the
now I
companies.
can already see you shaking your head, but that's something, at least for me, that I would be keeping an eye on, just sort of, if I was an investor inside of Activision, I would just want to keep a little bit of an eye on that,
Yeah, but you got to understand the nuances of gaming culture. So gamers like to complain about a lot of things, sometimes warranted, sometimes not warranted. And when I say warranted, it's because you just look at their actions and then you can see. So like, for example, EA in Battlefront 2, that was fairly warranted. And how I measure the whether it was warranted or not was the community, or the gaming community, truly, put their dollars where their mouth was, and they didn't buy the game. But then there's the complaints when they complain about something, but they purchase it anyway, because when you weigh, like I look at what someone does, not what they say, because then that truly tells me when they analyze the situation, they chose to take that action, and they had these overt thoughts that you were listening to, but then you saw their actions and they kind of just went against their own thoughts. So then what that means is that in their minds, they judge that the action they took was justified in whatever capacity. So that's how I approach that. If you don't see like extreme mass boycotts of a game or for whatever reason, I would just not put too much credence to that. So EA then, made their own corrections, right? And they saw, because, their pocketbooks hit, because when the customer really figures out that they have the power, if you just don't buy the product, it will cause the company to change. Then you'll see changes. And that's what, you'll see with EA. If you continue, if, like, for example, everyone said, we're not going to buy any of EA's products until they change X, X, and X. Then EA would have to change or die, because they can't put a gun to your head and take your money. So that's just not how it works. Same with Activision here. So as long as Activision is providing content that gamers are willing to pay for, because they're making the decision there, they're saying, okay, I'm going to give you this money for this product. Okay. They have decided that the product is worth more to them than that money. That's why you buy something. If you do that and you're buying something, but you don't think that it's worth the money, why are you buying it? You don't actually think that. You're saying it, but you don't actually mean that. That's the only reason why someone buys anything. Because the necessity of it, whether it's for pleasure or for just necessity, is the value in it of itself. So we're seeing here the current ratio. That was a little spiel, but the current ratio looks fantastic. Everything's been getting better with this company. Total debt ratio, everything's going to be getting better here. So we'll be very quick here. Gross profit margin, there you go. There's the software side. It's been getting better. So remember, another way a company can improve the cash flows is, aside from growing revenues, it's also improvements in efficiencies. So we got to keep that in mind. There's a couple ways to grow cash flows, not just, oh, you must grow sales. In fact, you can grow sales and deteriorate your cash flows, right? We got to be aware of that as well. So growth for growth's sake is terrible. But what we're seeing here is something good. Efficiencies are improving. Operating margins, they're improving as well. They're kind of returning to 2017 levels, but they're improved from 2018. Net profit margins, everything's good. I love this. ROA 11%, ROE 15%. Pretty good. All right, so now let's take a look at I just want to look at the earnings quality. Fantastic, amazing. And then I'm going to look at the inventory levels. Okay, so it's pretty good. Okay, so I want to see this maybe continuing. Negative cash conversion cycle is indicative of power that the company has. And I have nothing really stands out as bad or like, something that I want to really talk about too much, but
those 2 years are negative, most likely because there's probably a mistake in the model somewhere, which is why it's dividing those by 0, or there might not be.
No. Negative is actually value in the cash conversion cycle. But very good question. If someone might be wondering that, we did a video on Pepsi. Pepsi has a negative cash conversion cycle. And I mean, we're not doing a video right now on that, but because the video is already kind of
it's about Activision.
But that kind of summarizes my thoughts. To be fully transparent with everyone, I already added to Activision. I opened a position in Activision. I opened it on 11/11/2021. So that was the initial, and I added to the position in 11/12/2021. All right, so that's if you're watching this video, that is the up to date as currently. It's a position that I'm adding to slowly over time. So I started with 200 shares, and I think I didn't add much. I just added 50 shares. Then I'm going to be nibbling in here and there.
I started my position on 11/12/2021 as well, and it's a small position because, as you guys probably know, my portfolio is it's small at the moment. It's grown, but that's also indicative of just first starting as well. So
don't worry, that's gonna grow on its own.
So
to summarize my thoughts, I'm interested in Activision Blizzard. I'm buying at these levels. Nibbling because I want to see maybe this pessimism gets extended and I can get better prices, in which case I'll be buying more. As far as position sizing, which is sometimes the hardest question to answer after everything, after you decide you're going to buy it, et cetera, et cetera. I think for me, Activision Blizzard may make it to 5% plus, just depending on the price I can get it at. So for example, I think, let's actually go back to the model so I can go over with everyone my thoughts. If I can assume, for example, 15%, if I were to see in the 40s, this position would get pretty sizable. I'm talking 10% plus. So it'd be a pretty large amount. It'd be a lot of money in there. And if I could get it below there, so, you know, below 40, then, you know, it grow. I think I'll max it out when I did like kind of my extra analysis I did on the side. I think I came out to like a maximum of 20% that I would ever put into this company. And 20% is the price would be pretty low, but more or less the thought process is if I could get it with the assumption of 15% growth rate in cash flows, it could easily reach 10%. For now, if it stays at current prices, there's kind of a max cap at I think it's like 5-6%. And if it goes down to, if I can assume, I think it was when I did 17. Yeah, so if it reached $50, if it was $50, that's what's the price. $50, it'd get up there to 6%.
Well, you heard it here, folks. We are your hosts, Austin and Fabio. This was kind of our introductory preliminary analysis on Activision, ticker symbol ATVI. If you've liked what you've seen here today, please be sure to share the video. It really helps out the channel. And please be sure to visit our website at capitalmindset.org if you have any analysis requests. Now, as always, we do see the emails. We try to make these videos in a timely manner for all of you guys that have given us these requests to do. And with that being said, we're your hosts, Austin and Fabio. Please like, comment, and subscribe. Take care.